second video, we're going to look at the situation with monthly payments with credit cards. Remember that that is an example of open-ended installments, which means that the monthly payments are variable each month. There is a minimum payment required, but there is not a deadline by which you have to pay off the credit card in total. One thing we should know about credit cards is that no interest is accrued if you pay in full the first month. So if I open a credit card today is June 9th, I open a credit card today and I put $100 on it. On July 9th, my balance would be $100. I'd have to pay my minimum payment, which would be a part of the balance, but there wouldn't be any interest that accrued on that. But if I did not pay that off in full, then whatever would remain on my balance, I would have to pay interest on the following month and every subsequent month after that. One thing you also need to know about credit cards is that if you get a cash advance, there is no grace period. So this no interest if paid in full is called a grace period. You have a 1 month grace period to pay off the credit. But if you get a cash advance, they treat that like an immediate loan. And so there's no grace period for cash advances. You start paying interest on cash advances immediately. So one thing you need to know about credit cards is that every month, instead of having like a specific payment, like in the fixed installment loans, for credit cards and open-ended installments, there is a minimum payment that is due each month. And that payment consists of fees plus the interest accrued plus 1 to 2% of the balance. So that means if you purchase something and you pay your minimum payment, you're only chipping down at about 1 to 2% of the balance that you have. Most of what you pay actually comes from interest and fees. One other thing you need to know about credit cards and minimum payments is that minimum payments are always rounded up to the next dollar. So if my minimum payment was calculated, let's say at $27.32, this would round up to $28. That's not true rounding. It doesn't follow our rounding rules, but it's sometimes called common sense rounding. And in this case, it's because if you rounded down, you wouldn't be meeting the actual minimum that's required. So minimum payments always rounded up to the next dollar, even if that's not proper rounding. So the method we're going to look at is previous balance method, where the borrower is charged interest or a finance fee charge on the previous balance from the previous charge period. That's a lot of saying charge. Anyway, let's think about this. Let's think about if we have the first month, month 1. Let's say we have 2 people. We have Sandy, who is going to put $100 on her credit card, but she's going to pay it off before the end of the month. Pays in full. Okay? Stashy puts $100 on his account, but he does not pay in full. He pays the minimum payment. Now, these are my cats, so clearly they don't have credit cards. But Sandy puts $100 on her card, but she pays it in full when her statement comes. And she didn't accrue any interest on the balance because of that grace period. And so she's going to start off month 2 at a 0 balance again. So then she can spend money on her card, but if she pays it off again in full, she won't have to pay interest on those purchases. Let's say we have Stashy who puts $100 in his account, And at the end of the month, he doesn't have to pay interest on that because of the grace period. However, he will have to pay a portion of the balance as his minimum payment. So let's say the portion that they want him to pay is 2%. So 2% of 100 is $2. So he goes on to his online banking and he pays $2, meets his minimum payment. However, this means that his beginning balance for the next charge period is now $98. So at the end of his next charge period, he'll have a balance that will have accrued interest because the interest will be applied to the $98. And then his balance will also include any purchases he made after the beginning of that charge period. Let's look at an example together. On the March 7th billing date, Cara had a balance due of $320.03 on her credit card. The transactions during the following month were March 12th, she made a payment of $180.35. On March 15th, she charged pet supplies, which was $271.08. She must have expensive pets. On March 23rd, she charged a sofa, which was $822.72. And on April 2nd, she charged a gift that was $24.99. The interest rate on the card is 1.5% per month. Using the previous balance method, find the finance charge on April 7th. So she has a previous balance of $320.03 from the previous month, and interest is going to be charged on that principal. But then over the course of the following month, these are the changes that are made to the account. So if we're looking for the finance charge on April 7th, we're going to find out how much interest she's going to owe on that principal of $320.03. So we're going to use I equals PRT, and we have $320.03 times the rate times the time, which is 1 month, comes out to be $4.80. So this question asked for you to find the finance charge. What if they had asked you to find the total balance on April 7th? In order to do that, we want to start with that $320.03. That was at the beginning of her charge period. Then we want to subtract the payment she made, because that should be deducted from her balance, but then add the charges she made. And then we also need to make sure we add the interest. So when we do this, $320.03 minus the $180.35 plus the charges plus the interest, combining that all together, we get that her total balance would be $1,263.27. Please make sure you read really carefully what the problem's asking you for. The problem could ask you to find the minimum payment. The problem could ask you to find the finance charge or how much interest is being charged. The problem might ask you what the total balance is. You need to make sure you read the questions really carefully so you find the correct information. Let's look at the next example. On the November 4th billing date, Tasia had a balance due of $1,203.85 on her credit card. From November 4th through December 4th, Tasia charged an additional $106.94 and made a payment of $525. We're to determine the finance charge on December 4th using the previous balance method. The interest rate is 1.3% per month. So, remember, we need to apply the interest to the previous balance. So, we're going to use I equals PRT. We get $1,203.85 times the interest rate, which is 0.013, times the time, which is 1 month. Note that our interest rate is per month, and so since we're going from November 4th to December 4th, that is going to be 1 unit of time would be 1 for 1 month. But if it had said a certain percentage per day, we would need to make sure that we counted for the number of days in that month. This interest is going to be $15.65. Here's the second question, determining the new balance on the December 4th date. We would start with the previous balance. We would add the $106.94 that she charged, and then we would subtract that payment, and then we would also add to that our interest. When we complete those calculations in our scientific calculator, we get that she would owe $801.44 on her card as her balance on December 4th. That means that if she pays that in full, she'd have a clean balance, clean slate. But if she doesn't, then that would continue to accrue interest each month. So one of the things that we've seen is that credit cards use simple interest to calculate the finance charge each month. The finance charge, though, is sometimes based on the average daily balance, and the interest rate could depend on the number of days in the year or the number of days in the month. So one thing to note is that if you have an annual percentage rate, they're talking about for the year, but many credit cards actually charge interest per day. Some charge per month. But that's something that you want to be aware of, because it can catch up to you really quickly. Another thing to note that recently one of my colleagues and friends from New York had told me was that he had moved from New York to New Orleans, and he had put some of his purchases on a credit card, and he paid almost all of his whole balance, his complete balance, once he started his new job. But he accidentally shortened the amount that he paid by about $50. So instead of paying in full like he intended, he accidentally didn't pay in full. But the interest gets charged on the total amount from the previous balance. So despite the fact that he had paid, like let's say if it was $800, he had paid $750 of that, but his interest got charged on the entire amount, the entire $800. So please keep this in mind when you're using credit cards. We're going to look at a couple of examples where we're actually going to calculate a minimum balance or a minimum payment. The examples we've seen so far were not minimum payments because we didn't know the percentage of the balance that the institution or credit card requires you to pay for your minimum balance. So let's look at an example. I'm going to make it up. So here we have the situation. Anna's credit card company determines the minimum monthly payment as new interest plus 1.2% of the outstanding balance. The interest rate is 0.05173% per day. So one thing I want you to note is we have a daily percentage rate right here. Okay, Anna spends $3,900 on furniture on May 17th. Her previous balance was $0. Okay, so what is her minimum payment on June 1st? Well, if that is her first purchase and her balance was previously $0, then her minimum payment is only going to be the 1.2% of the outstanding balance, because that would be within that grace period of it being the first month, so interest won't apply. So her minimum payment for on June 1st would be 0.012 times the balance, $3,900, and so her minimum payment will be $46.80. But remember, minimum payments must be rounded up to the next dollar. So this would actually be a minimum payment of $47. Okay, so Anna's pretty smart. She's pretty good with math. So she knows that she shouldn't pay just the minimum monthly payment, because if she does, she's going to pay a lot more in the long haul. If you ever look at your credit card statements, they will often tell you if you only pay the minimum payment, It'll tell you how long it will take to pay off your current debt. And then it also tells you the amount of interest or the total cost of what debt you have that you'll end up paying back. And oftentimes it can be up to 4 times the amount of what you had spent on that item in the first place. So you kind of have to think about it. Is it worth paying 4 times a month or 4 times as much by paying with credit than it is to save to get it? I don't know. Again, your money, your life, but let's make sure that we're being thoughtful about the way we do things and that we're informed in what we're doing. I know credit card debt is actually a big issue for a lot of people, and I'm not gonna lie, I've had my own issues in the past. Anyway, we're told that she pays $850, which is a lot more than the required $47. So we take her original balance, $3,900, and we subtract the $850, which gives us $3,050. And we're gonna first find out what's the interest on this amount. So the I equals the principal, so $3,050 times the rate. Now, this is a very small rate because it's occurring every day. And so what I want you to do is make sure that you realize that I still have to change that to a decimal. So it's going to be an even smaller number. It's going to be 0.0005173. And then we have to multiply it by our time. And since this is in days, we have to think about how many days there are. So there's charts in the book that tell you like January has 31 days. February has 28 or 29, depending on if it's a leap year. March has 31. April has 30. And there's charts like that. But I don't want you to memorize charts. If you need to, you could count it up or think about how many days are in each month. There's a fun little rhyme. 30 days in September, April, June, November, 31, and all the rest, except for February. So, anyway, hopefully that helps. But there are 30 days in June, so we're going to multiply this by 30. And we're not going to use the banker's rule for this because the credit card companies are not using the banker's rule. They're using how many days were there? We're charging you. So our interest is $47.33. Now we need to figure out how much is 1.2% of the outstanding balance. So the outstanding balance is $3,050, and to find 1.2% of that, we multiply it by 0.012. And so to find her minimum payment, there's an 8 there. That's not supposed to be an 8. It's fine. I'm looking at this minimum. That should be an I, not an 8. Anyway, okay, to find her minimum payment, which I'm going to do in a little black cloud right here, we would take the interest on the previous balance and then add to that the amount that she owes on the outstanding balance. And we get $83.93, which rounds up, because these minimum payments, remember, always round up, even if it doesn't properly round up, but this rounds up to $84. But if she only pays $84, that means that she will owe a lot more in the long run. So that kind of wraps up our credit cards discussion. I went over those 2 examples, and a lot of the examples in the homework, there's only 10 questions on this 10.4 part 2 homework, and a lot of them are just previous balance questions, like using the previous balance method that we saw in those first 2 examples. But I did want to show you how to calculate a minimum payment, just because it's really helpful to know what your credit card companies are doing when they're calculating what those minimum payments are. I highly recommend that if you do have a credit card, you might want to look at your next statement when it comes up and really look at it and see how long it would pay off. It would take you to pay off that credit card if you were paying the minimum payment. And just think about it, if you were able to double the amount that you were paying and not add new charges to the card, think of how much you might save in those interest charges. It might be an interesting problem for you to work out on your own. If you have any questions, again, I'm not a financial advisor, so this is all kind of just like, this is where I'm coming from. But if you have any questions, please don't forget to email me. Thank you.